Hey everyone, welcome back to the channel. If you're a trader who's been in the game for a while, you've probably heard the old saying, cut your losses short and let your winners run. Sounds simple, right? But here's the hook that's going to challenge everything you think you know about making money in the markets. What if I told you that your profits don't actually come from being a genius predictor of stock prices? Nope, they come from something far less glamorous: protection. Yeah, that's right. Protecting your capital like it's your last line of defense in a battlefield. Most traders chase the thrill of nailing the next big move, but the real edge, it's in mastering risk management. I'll break down how to build that unbreakable risk-first mindset. Yes, risk-first mindset. Let's start by defining what a risk management mindset really means in the trenches of trading. It's not just about crunching numbers on position sizing, like risking 1% of your account per trade. That's the mechanical side, and sure, it's important, but the mindset goes way deeper. It's about emotional acceptance of losses. Losses aren't failures, they're just the cost of doing business. Think of it like paying rent for your trading office. Inevitable, but if you manage it, you stay in the game. Then there's probabilistic thinking. Markets aren't black and white. Every trade is a probability play, not a certainty. You're not betting on this stock will go up. You're betting on a setup with a historical edge, knowing it could flop 40% of the time and still make you money overall. At the core is capital preservation. Your trading account is your lifeblood. Blow it up and you're out. A risk mindset means treating every dollar like it's sacred, not fuel for ego-driven bets. And finally, detachment from individual trade outcomes. One trade doesn't define you. It's the portfolio over time that matters. I know this sounds straightforward, but if you're nodding along while secretly struggling to stick to it, you're not alone. That's where the real work begins. So why do so many traders resist this? Psychologically, it's wired into us. Humans hate losses more than we love gains. It's called loss aversion from behavioral economics. A $100 loss stings twice as much as a $100 win feels good. So we hold on to losers, praying for a turnaround, because admitting defeat feels like personal failure. Add in the dopamine rush from wins, and it's easy to get addicted to the excitement of big bets. Then there's social pressure from trading culture. Scroll through Twitter or Reddit trading forums, and what do you see? Screenshots of massive gains, moonshot predictions, and YOLO trades. No one posts their blown accounts or string of small losses. It's like the highlight reel of trading, creating this illusion that real pros are fearless predictors. But that's BS. The quiet millionaires, they're the ones obsessing over risk, not headlines. This ties right into something crucial: emotional capital. What is it? Think of emotional capital as your mental and psychological reserves, the fuel that keeps you disciplined, focused, and resilient. Just like financial capital, if you deplete it, you're done. A string of unmanaged losses doesn't just shrink your account, it shreds your confidence, leads to revenge trading, and burns you out. Preserving emotional capital means setting boundaries so losses don't wreck your psyche. It's why pros take breaks after tough days or have rules to step away if they're tilting. Without it, even a winning strategy falls apart because you can't execute it consistently. I've seen traders with killer edges quit because they couldn't handle the emotional roller coaster. Protect your mind as fiercely as your money. That's the key to longevity. Now let's get real about how poor risk management shows up in actual behavior. It's sneaky, it doesn't announce itself. Take oversized positions. You spot a can't-miss setup, so you bet 5% or 10% of your account instead of 1%. Feels bold, but one bad trade wipes out weeks of gains. Or moving stop losses. You set a stop at $50, but when it hits 49, you slide it to 48, thinking, just a little more room. That's hope, not strategy, turning a small loss into a disaster. Holding losing trades while cutting winners short? Classic. You bag a quick 2% profit on a winner because you're scared it'll reverse, but let a loser run minus 5% or more, waiting for a bounce that never comes. Let me illustrate with a realistic example. Say you're trading tech stocks in a volatile market like we saw in 2022. You buy into Tesla at $200, risking 1% on a $100K account, so $1,000 max loss, stop at $190. But the stock dips to $195, and you think, Elon's got this, it's just noise. You move the stop to $180.
Then it tanks to 150 on bad news. Now you're down $5,000, emotional capital drained, and you hold even longer, missing out on rebound plays elsewhere. Contrast that with a risk-first trader. They take the $1,000 hit, shake it off, and move to the next setup. Another example, day trading options on earnings. You cut a winner at plus 20% because profits are profits, but hold a minus 30% loser, averaging down. Result, asymmetric pain. Small wins, big losses. I've been there early in my career, lost 20% of my account in a month from this exact crap. It hurts, but learning from it builds the mindset. All right, enough doom and gloom. Let's flip to the practical side. Actionable frameworks to develop that risk-first mindset. First, fixed risk rules. Hardwire it. Never risk more than 1 to 2% per trade, period. Use position sizing calculators. Input your account size, entry, stop, and it spits out shares. No exceptions, even for sure things. Second, loss acceptance rituals. After a loss, don't sulk. Journal it. What was the setup? Did I follow rules? Then affirm. This is part of the process. On to the next. It normalizes losses emotionally. Third, daily risk limits. Cap your total daily loss to 3 to 5% of your account. Hit it, shut down the platform. This preserves emotional capital and prevents tilt. For probabilistic thinking exercises, try this. Review your last 20 trades. Calculate win rate, average win/loss ratio. See how even a 50% win rate profits if winners are bigger. Or simulate coin flips. Heads win $2, tails lose $1. After 100 flips, you're up even with 50% wins. Apply that to trading. Focus on the math, not the flip. Mindset shifts. Prioritize longevity over excitement. Reframe trading as a marathon, not a sprint. Ask yourself before every trade, am I okay losing this amount? If not, size down. Build detachment by viewing trades as experiments in a lab, data points, not personal bets. And surround yourself with risk-focused communities, not hype machines. Over time, this shifts your brain from thrill seeker to strategic operator. As we wrap up, here's the powerful takeaway. Risk management isn't a limitation, it's your ultimate performance advantage. In a world where markets are unpredictable, the trader who protects capital outlasts everyone else. They compound small edges into big wealth while gamblers flame out. Reframe it. Protecting your downside isn't boring, it's empowering. It's the foundation of long-term success, letting you trade with clarity, confidence, and calm. If you're struggling, start small. Pick one framework today. You've got the basics, now build the mindset. Thanks for watching. Drop a comment on your biggest risk mistake and subscribe for more real talk trading insights. See you in the next one.